Scott Gecas is here with us this morning. Scott, this ethanol report back up above 1 million barrels per day. So it looks like maybe we can hang a little bit of this corn demand on the fact that we are increasing the ethanol just a little bit.
Yeah, well, with the corn market in particular, I think we should see demand start to pick up. With the ethanol numbers that came out today at support of a price, but also the China's corn reserves are dropping significantly. So that just means that they're going to have to import more corn, whether it be from South America or the U.S. Just overall global corn demand, it should start to rise significantly. And then you also have the weather coming in. That's a threatening factor with the harvest. So we expect corn to get a little bit of bump up in price, a little bit of supportive news. So we have to wait and see. But overall, just with the total grain market, we expect light volumes over the next 3 weeks, unless if anything comes out with headlines. So we have the USDA report within 2 weeks. Supposedly, we're going to get something significant done out of the trade war talks in 3 weeks. So there's a lot of information that's going to be going back and forth. So typically, we wouldn't expect low volume going into this, but there's a lot of unknown factors going into this. And the only thing that's going to be driving price over the next 3 weeks or so is either weather premium or headline risk. So everything is just up in the air, and it's a wait and see. There's no really definitive one way or the other right now.
Scott, you mentioned that low volume. Does that tend to get us to just kind of trade in these ranges, kind of like what we're doing now?
Well, that's what is expected. But again, one tweet, one headline can completely change that whole demographic, and we can just move one way or the other. So in theory, yes, we expect to be range bound for the next couple of weeks. But again, headline risk that has been rampant for the last 18 months or so. I mean, that's what's really going to be driving these markets over the next 3 weeks.
All right, corn market up about 2 1/4 cents right now on the December contract. Let's get you the numbers. 388.5. And we're only a half a penny now away from the high. The March up 1 3/4. Over in the soybean market, though, we're back to the higher side with November up a half at 918 3/4. January up a quarter. Chicago wheat market started out the day 3 cents lower, and it's come off of the low of 507. Now at 510.5. That's down a penny. In the Kansas City wheat market, that July contract is steady, but the front month December's up a penny. And the Minneapolis wheat market, that market got started off to a little bit of a mix to kind of a choppy time of a start here today, too. Scott, over in the soybeans, we're firming things a little bit. Is that encouraging to you?
Well, that's encouraging, but again, this has to do with all the trade war talks. So if China does increase their imports with U.S. beans and their commitment to buy more ag products, then yes, I mean, we expect that to move higher. But if they just go with a complete, just pure dollar amount, just across the board, and say they fulfilled their commitment to, X dollar amount, well, then that throws a wrench in a lot of different things. So there's a lot of different moving pieces in this whole trade war talk, and everybody is waiting for definitive news. You see rumors out left and right, positive, negative, one day, the next day. Mm-hmm. So, I mean, the market's really just getting tired of, the rumors back and forth, and we're just waiting for definitive numbers or definitive news.
Okay, let's check the numbers on the livestock trade next. Stay with us. Scott Gecas will join us on the other side, right here on the Market Report. This protein complex seems to be catching a little bit of a buy here today, Scott.
Yeah, with the protein complex across the board, it is a little bit supportive. The cattle is completely in a straight uptrend. The trend is your friend. By any means, we're not looking for any type of pullback unless if we see a big drop in the cash. The third quarter production to the fourth quarter production, it's expected to drop. It's going to be a drop that we haven't seen in about 5 years. So that's a little significant. So that's another thing that is supporting the cattle prices in intermediate. With the hog market, it's a completely different story. The only thing that's holding it back is U.S. production is at almost record levels. So, but the other thing, China production is falling, and it's falling drastically. So when all this African swine fever started, they said if it was a 10% drop, that it was equivalent to all of the U.S. pork that was imported for 2017 and 18. So right now, the early estimates are 20 to 30%. Some analysts are saying it's going to be much larger, to the 50 to 60%, but any numbers coming out of China as far as production, I mean, you can take it with a grain of salt. So, but if you look at the option flow, the calls are still holding skew. You still see upside call buying. So we expect that import campaign to still continue throughout 2020.
Okay, Scott, thank you very much. Scott Gecas there in Chicago at the edge of the trading floor where we get the latest.
Yeah, good insight.